Good afternoon, everybody. I am Michael Marsh, CEO and founder of CRNA Locum Jobs. I'm a CRNA as well. We are going to be talking with Levi Carter today. He owns his own accounting firm out of Oklahoma City. We are going to be discussing CRNAs that make over 500,000.
Hey, Michael, how are you?
Doing well. I was just telling the audience we have quite a few, which is a lot, CRNAs that are making over $500,000 doing locums through our company. And probably the top 10, 15% of those are making over $650,000 a year. Was also telling them that you own your own accounting firm out of Oklahoma City. You're our personal and company tax person when it comes to all that, and you've done that for years for us, and you have a lot of great strategies, extremely knowledgeable. So I wanted to bring you on again today. I know we do a couple of these lives and people always want to see more of them. So today we're going to go over tax strategies and structures when you and your spouse or you are making over $500,000. I did want to start this just with a quick question for you, Levi. Would it make more sense to be 1099 making over $500,000, or does this still apply to people? Let's say you're making 600,000 W-2. What's a quick answer there before we dive into some potential strategies for these people?
Yeah, I think, we do have in another firm we own some high earning MDs that are just stuck in a W-2 situation. The counsel there is you just can't give that much of your wealth away. So you need to start a business so you have access to this. So even if you don't have the opportunity to operationally go 1099, the answer is always go 1099 when possible. When not, if you're in one of those really high earning W-2 gigs. That is the worst way to get rich in America, is what I like to say.
Yeah, the
So we
government
need to
loves
start
those
some
people.
sort of side auxiliary. Michael needs to take up knitting or something, create an Etsy store. We need something to kind of open, and then what we do is we just kind of funnel capital into the business and then do it on that side.
Right. The IRS loves nothing more than a high net earning man
Yeah.
and spouse, or two people living in a home both making a very high earning W-2 salary, because
Yep.
they're taking their chunk and then giving you the rest. And even if you are in that situation, one of you guys being 1099 would be super beneficial, right?
Yep. Absolutely.
Well, let's go ahead and get into it. I know I said there's a lot of our CRNAs who make over
Yeah.
$500,000. There's several that make six, 700, $800,000 a year, and that's not even including their spouse and what they bring in. So, what's kind of number one on your list when it comes to an individual or couple coming into you and saying, "Hey, it's 2025. We're going to make $700,000 this year,
Yeah.
and we're 1099." What's kind of your first couple things other than, putting kids on payroll, paying
Right.
a nanny or spouse, maybe buying vehicles? Well, why, as we kind of filter out those things, what are the next steps in making sure we're saving money on taxes?
Yeah, well, the first thing I'm going to start looking at, and 500 is an arbitrary threshold. What we're trying to describe when we say earning over 500 is when you go into that stratosphere. Maybe that's you live lean and that's 460 for you. Maybe you're in, working a bunch of overtime in New York and that's 700. Well, the scenario we're trying to describe is someone who has a lot of liquidity. When you have a lot of liquidity, there's zero reason anymore to pay taxes. The limitation on tax planning is not because, we ran out of good ideas. It's always the limitation is liquidity. And so it just gets really fun. The meetings with those clients are super fun. The first thing I'm gonna examine is, should we look at entity structure, doing entity structure a little differently? And what I want to look at is, should we create at least a C Corp management company? As you know, Michael, C Corps have a lower flat tax rate at 21%. And a valid question is, well, shouldn't I just look at changing to a C Corp to get that lower rate? And some of our CRNAs do that. But managing a C corp is very different than an S corp. An S corp is very much you and the corporation are entwined. You can pull that money out anytime you want. You can put money back in. C corps are different than that. You have what people refer to as double taxation. The corporation's taxed, then if you take a dividend out, it's taxed again. So if I don't get the vibe that someone's going to manage that extraordinarily well, or they're going to get some big dividend capital gains tax at the end of the year they weren't expecting, the safer way to do it is to utilize a management company off to the side and just manage. Let's say we management fee a couple $100,000 over there, and that we get a discount on those, that 250,000. And then you just have to, you've got to manage that responsibly. So send me an email if you're going to take money out. So we can take a loan from the C Corp, has no taxation. If we're short, like if you just, oh, I shouldn't have moved that 10,000 over there, I need to take 10,000 back, we can just run a payroll. There's no double taxation there. There's multiple ways to do it, but it's got to be a planning conversation. The key is it time for a more complex entity structure, or should we relook at entity structuring? But I did have a CRNA that just did change his whole operating company to a C corp that's always done locums, and he's like consistently a 700-800 grand. So we just, he doesn't tend to like to deploy it as much in real estate. So some of my other clients, and so it just piles up, and it's just getting this premium taxation treatment. He was just over it, so we changed everything, and we feel like we educated him on how to use that vehicle. So that might be a place where we start. We might start looking at entity structuring a little better.
Would the management company be the C corp and you would stay S corp? Is that what you're saying?
Yeah, I like
Okay.
keeping all the earnings in the S corp side, the sort of main source of capital on that side, where the client, doesn't have to remember a bunch of rules. They need to take money out, but strategically, maybe once every 4 months, we're going to look at the growing pile in the S corp and see how much, it does need to be reasonable from a management company fee, how much that we can reasonably, move over to the C corp. So we'll evaluate. It's really just kind of a holding place. You can invest those funds. You can put it brokerage in the C corp. So it can grow, but it's a place where those retained earnings don't have just such a heavy tax premium.
Yeah, you brought up a cool point too, is you can take a loan out from that management company that's a C corp. So
Yeah.
that loan could be a balloon loan to where you're paying interest only for
Mhm.
7 years to yourself into your C corp, but that interest is only taxed at 21%, but you're able to essentially pull that money out to buy whatever you want. Maybe it's an investment,
Yep.
whatever the case is, you pull money out of your management C corp account as a balloon loan, and then your earnings account just pays that balloon interest for
Yep.
7 years at very minimal tax rate, and now you have access to your money. So that's really cool. It's a great way and a great structure to have if you're making six, seven, $800,000. Anything you want to add there?
Just real quick, I'll keep this brief, but to your point, I'm glad you went that direction with your follow up, because you actually can kind of get this sort of double bang for your buck from a tax planning standpoint. If you move the funds over there, and then let's say you take out that loan to be the down payment on a real estate investment property, you're almost getting this discount over here on taxes, discounted, tax premium with the lower flat rate. But then we're able to take those same funds back out and still use them for an additional tax planning. There's not a whole lot of things where I can use the same dollar twice for tax planning. So that piece of real estate is going to spit out a bunch of depreciation, presumably too. So it's a great usage of it. Loans do have to be bona fide, so we got to paper it. I like using it for down payments on real estate, because one of the bona fide test that the IRS uses is this secure? Well, if you're using it for down payment on real estate, it's secured. It's like it's debt. So what you don't want to do is take a bunch of loans and quotation marks, and it's just really you taking distributions. The IRS auditor will just change that to dividends if it were to be examined. So it's got to be
Right.
bona fide. That's a great way to do it.
And just real quick before we move on
Yeah.
to our next point we want to go over is the cost segregation. You mentioned taking out from your management company that's a C corp. You take a balloon loan out to your personal, you're able to get that money. Now you're making a down payment on commercial real estate, whatever it is, an investment. And right now the government's allowing, is it 100% bonus depreciation, and you get that property cost segregated?
Yeah, absolutely. At 100% bonus depreciation, each asset class is different, but a good benchmark is If you're buying the right type of real estate, and you can go back and listen to some of our earlier ones about what you should be buying if you're a high earner, you should be focusing on the right type of assets that you're acquiring. If you're a high earner, that are these that are going to spit out great depreciation. A good benchmark, if you're buying the right type of assets, is 25%. Count on that cost seg giving you 25% of purchase price in year one depreciation. So you're buying a $1 million office buildings. You can count on that spitting out 250,000 in year one depreciation.
Which, when you say depreciation, that's actually a deduction on your
Right.
taxes. So
Yep.
that's $250,000, $250,000 you're able to deduct on your taxes, even if you're able to get a cost seg done now, which would late in the year, but you buy a property right now, get it cost segged, and you
Yep.
can write off 100% of that. And let's say it's $250,000. Now you have a $250,000 deduction on your taxes. And if you're making $500,000, now you just have $250,000 to worry about. And with Levi's help and all the other things out there, you guys are able to get that number down much lower. Um, the
Huge.
next thing,
Yeah, and the
yeah,
caveat there is, of course, that you always have to figure out a way to take the loss, the passive loss limitation. But again, I'd refer you back to Mike and I's prior videos or some of my webinars. So there's almost always a way to figure out a way to take it. There's 4 or 5 different things. But yes, presuming that it's not just locked up in a suspended passive loss, it's massive.
right. Another thing we wanted to talk about was
Yeah.
defined benefit plans. And this is, again, for people making 550, six
Yep.
hundred, 700, $800,000. Can you touch on that? Because I know a lot of our audience probably hasn't heard of defined benefit
Yeah.
plans. And also, if they have, do they really understand it? And if you could make it, educate everybody and make it easy for us to understand, that'd be awesome.
Yeah, I think the easiest way to explain it is the IRS, that what you hear is the most you can do is that 70,000 number, a little more if you're older, over 50 or whatever. What you have to understand is that the IRS views retirement plans in 2 different buckets. The one that everybody talks about, the $70,000 limit, is a bucket called that the IRS calls defined contribution plans. Defined benefit plans are the second bucket. What defined benefit is normally, what you probably have seen at a hospital you worked for historically, is normally called a pension. That's what we refer to as pension. So it's not subject to that $70,000 limitation. So it allows us, especially for a CRNA that is starting to be kind of at the midpoint of their career, pension math wants to get you to your current level of earnings in retirement. So what the pension math's going to do is, hey, this person's in their 40s and they're making 200 grand a year. I don't have as much time for compound interest to do the magic. So the pension math says, give this employee a ton of money in their
Mhm.
plan. And so, I have one with real middle of the road with a couple that's even younger, and they're still able to put 200 grand in that thing total, between the both of them, and they're in the younger side. So it can go. I have a one that's more, they're in their early 50s that they put in 400 a year. So you can get massive amounts. And here's where, I always treat tax planning, as, like a menu. Different people like to use their money in different ways. Where I'm really starting to kind of get pushy on the DB side is when I have a CRNA who doesn't love real estate. Like, that's honestly what it comes down to. There's nothing else in the universe that works the magic that real estate does. Um, you know, um, so, but there's just a lot of people that aren't comfortable with maybe that amount of debt. I have a lot of real estate, but I have a lot of debt. So that's okay. So where we start to push people in the DB direction, if they're making 600 grand a year, is like, well, you don't have the chunk play that I do with 400 grand of depreciation every year. So we need something else that's sizable. So that's the gist of it. If you don't love real estate, I think you've got to find another big chunk play that really really helps you. And if you're comfortable with the retirement products, then we'll kind of take someone down that lane.
So that defined benefit plan, maybe you're taking $200,000, and it's essentially an additional retirement plan that you're able to get into. Is it 59 and a half? What's the age when you can actually start withdrawing from that account?
It's the same age. I will say I have people that are over invested in retirement plans, And I do remind them that they can retire early still and access that money through what's called substantial SEP with two P's, substantially equal periodic payments. So if you do find yourself in a situation you go, hey, I should be financially free, but I'm 51 and I can't access this money yet, there is a workaround there. I have one client last year that's taken that option. So it's not stuck, but in theory, yes, it's got that same 59 and a half limitation.
Yeah. So an example would be a CRNA making $600,000 that really isn't interested in real estate, wants to retire heavy, wants to retire early. Maybe they're 33, 34, 35, 36 in their mid 30s. They can get this defined benefit plan, heavily loaded, and then maybe at 50 years old work with you guys and find out a way to actually start pulling money out of that. And
Yeah.
maybe it's only 2 to 4% a year, but they're able to live off that, and now they're retired or maybe only working 1 day a week.
Yeah, and it's gnarly on the fee front. So you want to, I always tell people, I want to hear from you as the client that you want to do 200 grand or 250 grand to make the cost benefit of this make sense. And then just so you know, you don't have to live with those high administrative costs of a pension forever. What you can do is you can retire and do a rollover into, or even just stop the defined benefit plan and roll over into your 401k, or you can retire and you roll that into the IRA without all of those fees. But now, in theory, that all that math works great. Like if it costs us 5 grand to administrate this thing a year, and a solo DB with one owner could probably be more like four. Okay, but we're saving at a 40% tax rate. Let's say we use the 200 number. We're saving 80 grand. It's costing us 4 grand. That math works okay. It's still a fee nobody likes paying. I can't change that. But what I don't want to do is get you into something where you're on the hook for that level of administration and then you put 70 grand in it next year. Because I could have done that in a 401k. So we're kind of looking for like, okay, are you sure you want to go this direction? Because I'd like to you to choose this lane and go hard if you're going to do it. But in theory, if we're talking about people making 600 grand, again, there's a lot of cash laying around. So that's not the end of the world for them. Like it would be someone making 300 grand a year.
Right. So moving on to our third point here is we're gonna talk about, which is it's a type of health insurance, right, Levi? It's reinsurance captive, an insurance plan, and that's something you can do as an owner of your LLC or S corp or C corp. Is that correct?
When there's it's not health insurance. When there's,
Okay.
it would be for like kind of like an extra layer of business insurance.
Okay.
When there's this much money laying around, we just go into kind of sort of some lanes. Again, we don't need it. By the way, me and Mike are both real estate guys. Like, you don't need any lanes if you like real estate. We don't have to do anything funky. Like, I have clients that make a lot of money, and all they do is real estate. But again, there's just situations where people don't know how to do it or don't have the time and aren't comfortable with passive. So we should start going down sort of these more unique lanes. Defined benefit actually isn't the most unique lane, but we start looking at outside the box. Reinsurance is a way where it's kind of a different version of captive insurance, which is there's a lot of IRS rules around it. People will tell you it's illegal. That's not true. The IRS can scrutinize it closely. So you want to bake that into, do I want this? But them scrutinizing it closely and you having lots of rules to follow doesn't mean that it's illegal or wrong to do. But it's basically a savings account that you can pull from if you were to be sued, or something like that. You can allocate a certain amount of funds as insurance, and we can make an expensive version of that as captive insurance. So think of it like a savings account, kind of like we're talking about parking money in the C corp. You can invest it in there. It can grow in there. It's still a part of your nest egg, and we can get it back out and accept the taxation, by the way. So that's a really important part. It's not just stuck in the ether. Captive insurance, you might Google that today and you find out, oh, that cost me 50 grand a year or something. Ultra high net worth individuals use captive insurance for the same reason, that the administrative fee to make sure you're compliant is very heavy. Reinsurance is a different version of that. Usually it's a contract with a third party, and basically this third party. So it's actually scrutinized less than captive insurance because it's not captive insurance. It's not your own savings account. It actually is a third party. Usually they're organized recognized under tribal law. Otherwise, they'd have to register with the state insurance commission. So there's a lot of people that have these groups, and you'll put money in, they'll take a 10% fee, put 100 grand in, they're going to take 10,000 of those dollars. You go, well, I don't like that. That's true, but the theory of the strategy is that you're saving 42,000. So now your net savings is just 32,000 by parking it over there and letting it grow. So, I always walk people through not audit risk, but here's the rules. And, sometimes these have lost in tax court. Sometimes they've been upheld. So that's just it. I'm using that one as an example. There's really narrow lanes. There's equipment. I just had a client brought. She's probably going to do it. There's equipment syndications. Where people like operating companies, they need to buy a bunch of equipment in their operating company. They'll put that in a partnership, and Mike will invest in that partnership. Well, Michael then gets all that bonus depreciation. And by the way, but equipment is 100% financed, unlike real estate. So the bang for your buck on that versus a finance piece of real estate is it's extraordinary. So she'll put in $1 and she'll probably get 160 back in depreciation. So I'm just saying there's all these different little lanes. If someone wants to learn the world, just like the IRS has incentivized real estate, they've also incentivized oil and gas. It's written into the code. Oil and gas, the special thing about those investments is that they were intentionally built to incentivize people by making them active losses. So you don't have to do the gymnastics that we have to do with real estate to make sure you can, take the passive loss or whatever. So there's all these little narrow lanes. And so you might just try some of them. See if you find a lane like, oh, I loved working with that group. Maybe you just become an oil and gas guy instead of so you might just try, if you're sitting on 700 in earnings and you're living off of 250 in that, you might try some of these auxiliary lanes and put 50 grand in one and 40 grand in one, whatever their minimum check size is, and see if you find a lane that works for you. But
Yeah, that's awesome, Levi. We have a couple more minutes. I'll
yeah.
just go over briefly what we talked about. People who are making five, six, 700 plus $1,000 as a CRNA or a 1099 couple, defined benefit plans as a reduction. We talked about entity changes. Maybe you go from LLC or S corp to a C corp. Reinsurance, captive insurance, oil and gas, being able to invest in those type of assets. So I always like to ask this, and I'll ask it on every live. How many, or do you have any CRNAs? I know we've worked together for years, and you worked with a lot of CRNAs out there. And by the way, guys, if you want to find Levi, you can find him on our link tree, or he's through his Instagram handle right now, CBFC. But how many CRNAs, or do you have any that are making over $1 million?
Oh, that's a great question. I think I had I actually had my first $1 million nurse was a travel nurse during COVID. It wasn't a CRNA, just a nurse. And then I think I've had two CRNAs since then that have had over, just went right over the line. But I always have a half a dozen crazy locums people a year that'll just do a crazy year and do 600 to 800. Yeah, I've always got a handful of those. So.
Yeah, we have, I think our top 10 are well over 700,000 each year. Even maybe our top 25 CRNAs in earnings make over $700,000, which is crazy. Now, they're probably working a lot more hours, but also if you didn't want to work a lot of hours, locums allows you to work half the time or a few days a week or whatever you want that schedule to be and still make a lot of money and have access to not just these things we talked about today, but other avenues of deductions when it comes to taxes.
Yeah, no, it's incredible. I don't know when these people sleep, but I love the idea of someone doing a grind year or two on the locums front early on in their career. I
Mhm.
mean, you make $1 million 2 years in a row. I mean, as a 28-year-old, you don't really ever have to think about
Oh
money
my
again.
gosh.
You
Yeah,
know?
and it's possible. Well, Levi, it's awesome talking to you. I
Yeah,
know we'll
see
probably
that.
get requests to do more of these, which we will. You have a busy season coming up in about 3 weeks, so I'll wish you luck. I know it's going to be busy for probably
Yeah,
5, 6, 7 months,
yeah.
even with the extensions and company returns and all that. But you can reach out to Levi and his team. He's built a huge team in Oklahoma City.
Thank you, Michael. Thanks everyone for joining.
Of course. Take care.